Stocks slid Friday, closing the week lower as investors weighed May jobs data. The data likely gave the Fed a signal that labor market conditions can absorb a more aggressive rate hiking cycle. The sell-off was led by tech stocks, with the Nasdaq Composite falling 2.5%. The S&P 500 fell 1.6%, while the Dow Jones Industrial Average shed about 1%. The employment report published Friday showed 390,000 jobs were added to the U.S. economy in May, and with the unemployment rate holding steady at 3.6%. So although job growth slowed from April, the labor market remains tight, suggesting the Federal Reserve may proceed with tightening monetary conditions further by raising interest rates. And this is a big worry for investors who fear rate hikes may tip the economy into a recession. The fear is real, as Fed Reserve Bank of Cleveland President Loretta Mester indicated that she supports half-point rate hikes at the next two policy meetings in June and July, and more in autumn if prices don't cool. Add to that the stern comments from J.P. Morgan boss Jamie Dimon, who warned of a hurricane bearing down on the U.S. economy. And if that was not enough, we had Elon Musk state that he has a super bad feeling about the economy and said in an email to executives that Tesla is expected to trim about 10% of salaried jobs. So be prepared. Now, let's take a look at the hurricane. And today we're going to take a look at two very important charts. You've seen them before, but we're going to go through them. This is the 2-year chart of the volatility index. And as you can see in the upper left, the symbol is $VIX using stockcharts.com. We've been watching this. This is a beautiful dish here. If this was a stock, I would be very interested for a number of reasons. First, that dish, that nice long-term bottoming and basing, and then since say mid to late 2021 we have some very nice cycles, very symmetrical, up and down, up and down, up and down, up, and we're coming on down. The problem is that we are having higher lows. So this low here in the June-July period, we had a slightly higher low, and then once again higher, higher, and it looks like the setup is once again going to be higher. That's dangerous because the VIX moves in opposite of the stock markets. So when the VIX comes down, the markets head up. But when the VIX heads up, the markets head down. And I think the probability is for a bottoming and a basing here near the 50 and the 200 moving averages in this area here. So if there's a bottoming and a basing and then a move on up, all bets are off. Down here in the lower portion, we're looking at the MACD. Both the fast line and the slow line are above that zero line. There's strength. Very symmetrical moves. We're coming on down here. It looks like it's starting a bottoming and basing, which may continue into next week, maybe the following week. Watch that. Up here in the upper portion is the RSI. It does not want to go below that 50 or midline. There's strength. And when there's strength, that means the VIX might move. We might have an eruption. Watch this very closely. Now, let's go to our charts. And this chart here is the 10-year monthly chart on the spiders, the SPY, and the close on Friday was 410.54. And I'm looking at the 10-year. We don't do that too often, just to give you a little bit better view of what's happening. We definitely have this nice move on up. However, we're coming into this point here. We've already sliced through the 20 EMA. I was hoping for a bounce and a reflection on up. We didn't get that. And I said if we go through the 20 EMA, all bets are off. We may head to the 50 EMA, which is down here. We still may, so watch it very closely. We could slice through that as well. Be careful. Now, here's the problem that I see. volume's not going to tell us much, but into the MAC. You can definitely see the fast line sliced right through the slow line, heading on down, and it is accelerating. We still have elevation, there's still strength, but when stock market gravity takes hold at these heights, it doesn't let go very easily. We're speeding on our way down, and you can see that here in the histogram. From that top, we came on down, and we're moving on down here. I don't see any slowdown yet. Hopefully we will relatively soon, but again, watch that VIX, because if that VIX bottoms, base heads up, the market is going to continue heading on down. Now, to me, that's not bad. I got a stack of cash waiting to be deployed. But for you, just be careful. Stack your cash. Be ready for the opportunities, because there's a lot more opportunities coming now. Into the price rate of change, you can see too acceleration, that differential between the fast line and the slow line heading on. We're right at that zero line, and it looks like we may pierce through that. Into the relative strength index, the RSI, we're below that 50 line. It's not too far below, but it's kind of waffling in this area, not giving us too much of an indication. Into the stochastics, that is giving us an indication, with the separation between the slow line and the fast line also continuing on down. We're below the 50 or midline, and I think it is going to continue further. And down here into the Williams, we do have a little bit of a bounce off of, say, this mid area of the oversold territory, but we have this fish hook. We may head back down again. Let's go back up to the price chart. One last look. Simply because we don't see a bottom or basing yet, I'm going to stay on the sidelines. Keep stacking that cash for those opportunities. These are the times that you look for, when the market heads down and there's lots and lots of fear. Buffett says, when others are fearful, be greedy. And for today, that's ChewDog Charts. Thank you.